very excited to have a speaker on the topic of ESG, which was also a topic that was ranked very high in our membership feedback form. And we have a great speaker today, a very experienced speaker that worked as a chief actuary, chief investment officer in both the pension and in the insurance sector. Has more than 30 years of experience and has been also involved a lot in sustainability. So when I read out the information is that he has been part of the sustainability board for the UK Institute and Faculty of Actuaries and is currently leading 2 task forces on this topic. And therefore, yeah, we have an excellent speaker to tell us more about the current status of ESG and climate risk, but also potential pitfalls and the kind of challenges that we might face when making this this transition. So, without further ado, I'll give the floor to our speaker, Matthew.
Thanks for that introduction, Sebas. If not me, then who? And if not now, then when? I can imagine this is what was going through the mind of several of the scientists who around the world on Easter weekend were protesting. They were disappointed with the amount of progress being made on climate change. What exactly was their complaint? And why were they out in force so much? Their main complaint was that the Paris Agreement from 2015 had made a plan to keep global warming to 1.5 degrees centigrade at max over pre-industrial times. But now that plan is dead. It is difficult to see scenarios in which that goal will be reached. That is what they were complaining about. And they've had a chance to talk to the world about it. I'm sure you've seen this kind of graph some point in your thinking about climate change, that for thousands of years, the concentration has been quite low, but only in the last, say, 100 years has it precipitously rose. Let me show you a different way to look at this. This might be how the scientists think about it. In 1989, sometime around the wall was coming down, the scientists say we have no time to waste. And that led to the first intergovernmental panel on climate change in 1990. That's a governmental panel, even though it says governmental panel, it's a bunch of scientists that got together, like 1,400, a huge number of scientists. And they made their first report. These reports generally tend to be about 4,000 pages long, something like that. The one that came out this year, there's 3 different drops of about 4,000 pages each. Quite detailed review of the situation. They don't do any research themselves. They actually try to say what has been found in other places. At that time, they said the black line indicates how much carbon emissions have occurred in the world, not the total amount. That's the amount that's being let out every year. If we want to not have a bad future, a hothouse future, we should decrease our emissions. And they offered a path of how that should happen. Time went by, and a conference of the parties, which is a group of 197 nations, at least that's the number now. I don't know if that was the number in 1995, but they had a meeting a few years later, and for a moment it seemed like there was progress. If you can see this very dim line behind it, you can see that the emissions seemed to be a little bit less than the previous estimate of where they were going. Although they met, there was a lot of division. They couldn't really decide what to do about it. But then in the Kyoto Protocol that came out of the COP3 in 1997, we could see that emissions were taking off again. I would like you to notice as I go through these graphs that this blue line, the recommended path in this one in 1997, keeps getting steeper and steeper. It keeps getting tougher and tougher. 2001, the World Trade Organization had some things to say about it, to no effect, basically. You will see that the rise in emissions over the next 10 years is about 50%. By the time we got to the EU emissions trading being implemented in 2005, they were higher still. And again, you can notice that this pathway is getting quite steep if we're going to try to avoid any type of disaster. Further to the UK emissions came into force in 2008. Emissions were still climbing. Not that the UK is a big part of the world, but then came 2015. 2009, when COP15 again failed to agree to anything. Then in 2015, this is where the Paris Agreement actually took place. At this point, emissions had already grown to over 40 gigatons per year. This is what the scientists are now claiming is a goal that was decided by the COP21, but doesn't seem like it'll get met. And again, notice how steep this curve is. Emissions have to drop a lot if they're going to try to meet that goal. By 2018, the scientists had another thing to say. They said the effects of a 2% increase is much worse than 1.5. It's not a linear effect. And by 2020, we started seeing Australian and Siberian fires, and the Arctic temperatures were spiking more than they ever had before. So this is the graph of recent times, and behind it you can see our overly optimistic views, our overly optimistic projections that we've had on an ongoing basis. So I was thinking about this. I'm an actuary. I can look in the past. I can do statistics. What do I think the future is going to look like? Well, just looking from this black line and taking here to the future, the red line is my best estimate. And if I have a 1 or standard deviation on either side, it looks like we're going to be increasing emissions going forward no matter what. This is what the scientists, the climate scientists, deal with every day. This is why it's disappointing. This statistical analysis includes some science. It's just these points about emissions, but it's also including the behavior of people. There is very little effort to try to address this issue. It does seem that 1.5% is 1.5 degrees is a dead goal. Current policies, the scientists tell us, put us on a trajectory about 2.7. Remember I said 2 is much worse than 1.5? That's the current trend. But even just recently, and I give links to a lot of the things I say here, a new scientific analysis said that out of 16 tipping points that they look like, 4 of them have moved to likely. That means that they will be triggered at 1.5 degrees, which is where we're going. And those 4 tipping points are the irreversible collapse of the Greenland ice sheet and the West Arctic ice sheet, immediate loss of coral reefs globally everywhere, and thawing high normal permafrost. All of these will be events that release further carbon into the world. That's why they're called tipping points. They, in a non-linear fashion, all of a sudden make the problem that much more worse. As an aside, how do they make these graphs? So how do you decide what the path must be? There's a thing called a carbon budget. How much more carbon dioxide can we, or other greenhouse gases, can we emit before the temperature starts going up? This idea of a carbon budget says how much left can we put into it? The carbon budget now is estimated about 400 billion tons, 400 gigatons of carbon dioxide. If we exceed that, it will definitely go higher than 1.5 degrees. So, quick analysis. Looks like we're doing about 40 per year. At least this was 2020. Budget is 400, so that gives us 10 years left. You might recall that the scientists say we have about 10 years left. That's not saying the world will end in 10 years. Some people try to spin it like they were crazy. That's just saying that's when this budget will be reached, and we will definitely exceed the target that we've set of 1.5 degrees. By the way, about this 400 billion, this is not like a budget you have money in the bank. This is a scientific thing. Notice this 66% on the side. The 400 billion depends. Do you put it all in today, or do you wait until 2050? What other conditions are around it? They have statistical models based on a lot of different scientific stuff that I have read but don't understand deeply as much as they do. So they say things like 10 years with 66% probability. The budget might be 500, might be 300. This is scientists being honest. But sometimes in the press, this is used to get the public a little more confused. 66%, aren't they sure? Why don't they come back when they're sure? That kind of idea. By the way, how big is 1 gigaton? Well, we can say it's 1 billion metric tons. Okay, that's not very helpful. It's 2.2 trillion pounds. Okay, okay, we've converted into pounds. Nice. But the best estimate is 10,000 fully loaded US aircraft carriers. So no longer a gas, you have carbon in some sort of powder, and you fill up all these aircraft carriers with carbon. That's the amount we're talking about. That's just 1 billion tons. For reference, there are 11 aircraft carriers from the US nowadays. So this is 1,000 times as many aircraft carriers, or 900 times as many aircraft carriers as actually exist. So just to put some numbers beside all that. In making these scenarios, there are different groups that make these scenarios. One that you'll bump into if you start working on this is the NGFS, the Network for Greening Financial Systems. They have thousands of scenarios, but to make it workable, they boil it down to 6, and you'll see a lot of these used in different papers. These are the 6. So if you look at these, the divergent, on this graph up here, we have physical risks. How bad is the climate getting compared to how much is the transition risk? How much effort do we need to put into things? With very low physical risks, it makes a lot of effort into trying to change the economy so we won't have any physical risks. With our current policies, we don't have to do anything. Transition risk is almost nothing. But that'll be the most hothouse world there is. And just for reference, the current policies that we're using are this last line. This is the statistical analysis, the line going off to infinity that I showed in the previous graph. That's our current policies. Without much change, that's what will happen. Have a nice day. So the point of this talk is that investors can save the world. Investors have money. We are the gatekeepers of the money. I work in an insurance and pension funds. That's about 1/4 of all the money in the world. It's not like I'm the chief investment officer for all of it. But if we could figure out what we need to do, how to implement it, what are the rules for asking what is it we should be doing, then we can save the world. Now, I'm not a CFA. I'm not that trained of an investor, but I have a lot of experience. I am an actuary. I'm actuary in 3 different countries. And I tell everybody, it's our job, it's your job to save the world. Nobody else is doing it. Now, you might have noticed by my accent, I'm American. So a long time ago, John F. Kennedy said, and so my fellow Americans, that's my Boston accent, by the way. And so my fellow Americans, ask not what your country can do for you, ask what you can do for your country. It's a very, very famous line. Really good politics too, by the way. It took a marginal presidential win and made him into one of the most popular presidents of the United States for a long time. A lot of people don't do the second quote. He went on to talk to he said, my fellow citizens of the world, ask not what America will do for you, but what together we can do for the freedom of man. Great words. So I'm here to say, that's me, Matt Modisett. My fellow investors, ask not what climate's effect will be on your organization. Ask what effect your organization can have on climate change. This is a main concept, a main theme that I would like to discuss tonight. When we talk about ESG and we talk about climate change or governance or other things that we can do, the analysis has gone a little bit off. We have asked the question, all these changes that are happening in the world, is that going to hurt my fund? Is my company going to lose market share? What is the effect going to be on business? That's one question that's interesting, but there's another question that we should be asking, and it's more important. So while you're saving your company, save the planet. There are investment opportunities. Again, I've always worked in the insurance and pension side. There is a larger fund side. I've done some fund investments as related to insurers that I was working for. How will the insurance market change in terms of climate change? These will all lead to investment opportunities if you do investments for insurers or pension funds. One of the basic things is what I just showed a moment ago. Climate change is not a risk. It's a trend. Okay. When we talk about a risk like a car accident, I could have a car accident tomorrow. Or if you talk about a life policy, is this person going to die this year? These are risks. These are bad things that can happen to you. But a risk also has a chance of not happening. That makes it a risk. If it's definitely going to happen, it's not a risk. It's just a trend. So the NGFS 6 scenarios I showed a slide or two back made an interesting point. There is no scenario without climate considerations. It's either a physical risk, or it's a transition risk, or it's a mix. But it is happening one way or the other. We have to include that in our analysis. To go on about this point, and this is a big lead in to the introduction, actuaries and investors, they have a responsibility for the public interest. Yes, we want to make profits and we want to have a good career, but it's written into all the charters that I've known in the actuarial side, and it's written into the CFA Institute's mission and vision that we are here for the ultimate benefit of society, which doesn't just mean giving them good returns. It also means letting them keep lifestyles outside of what we do for them, not doing harm. I think it's easy to get lost in that as we go further. Just as a quick one, these are actuarial examples in general. I apologize for that, but I think that they're easy to understand. There is a social versus company tension in all of the economy, but also in what we do. As an actuary, I have to set reserve for policyholder future requirements. As a company, they would like those reserves to be low. But if I'm talking about societal good, my policyholders' good, I should tend to make them higher. Maybe not so high as to put the company out of business, but conservatively. Same way with capital requirements. Another example from the past is that there is longevity risk in pensions, or at least there previously was, when there was defined benefit pensions. As you save, it's determined what you will make in retirement. But modern pensions are a defined contribution. You add some money to a pot, it gets some interest, it gets returned. If there's enough there when you retire, that's good. And if it doesn't, well, sorry about all that. That particular example is, I think, a failure of my profession, the actuarial profession. Decades ago, back before I was born even, they noticed that there is longevity risk in pensions. And the solution was to change the pensions from defined benefit to defined contribution. That way there was less risk for the company. But they left all of that risk to the pensioners, the people who cannot understand it the best. They certainly don't have the means to manage it. This was a failure of taking care of society. It's not defined that way in the literature, but I think it's a counterexample to say that as professions, we must be more careful, or we could do the same thing in climate. The fourth one is a kind of technical actuarial one, that Solvency II capital requirements don't apply to pension funds. That's because if we did it, they would go bust. That's the real reason. Shh. Everybody knows it. So they continue the old methodology. And that's good for the companies. They can continue doing what they're doing and they don't go bust. But it's just building up more of a pension problem in the future. What's the effect on society? That's coming out now again, picking on two pension ones, we see the pension crisis coming forward, and we were part of the cause of it. Banking crisis, 2008. Banks were in trouble, print a lot of money, quantitative easing, make big words for it so people don't know what you're exactly doing unless you're paying attention. This was good, put capital into the banks. They promised that they would put it out to more people, and they didn't do as much as they were supposed to, but job done. Companies are saved. Now that money has been floating around for a decade or so, we're beginning to see inflation coming out. We don't know what the long-range effect of all that are. Were we actually working in society's benefit when we were a part of that? So I'm going through a few of these examples to sort of set the stage in climate work and ESG ratings. Customers demand that their investments are good for the planet, for society, for equality. And we've come up with ESG ratings. And the answer to the question, what are these things going to do to our company? That's not what the people originally asked. They said, is my money hurting the world? ESG doesn't generally answer that question. Customers demand for ESG or investments to save the world, not companies. They want to have an investment, but they're actually interested in, is their money hurting anything? When we're doing stress tests to our company, there's also a question of which scenarios do we use. I'll come back to this issue in a moment. We could choose very mild scenarios, and then our company looks great. But maybe we should choose the more tougher scenarios to actually see what the risk is, to make that line to infinity extrapolating that I had earlier. Save the world. We have the assets to do it. And the good news is, at least insurers as an industry are immune to climate change. That's a weird, controversial thing for me to say, perhaps, but it's true. If some places flood too much, insurers stop selling flood insurance. If there is a bad, low profit or negative profit margin area, as an industry, they'll just exit it. Oh, okay, maybe if everybody dies, then there's no market, that would affect the company. But as an industry, it's not going to cripple the insurance industry, and it's probably not going to cripple the investment industry either. It's not an existential crisis for us like it might be for a fossil fuel company. So we have the assets, we have the mandates. What are we waiting for? Well, maybe just my presentation. So, actuaries save the world, investors save the world. Here's an example. It's not worth going into too much, but the Solvency II, the regulator for insurance companies, decided to remove climate change requirements from their draft proposal. So there is a lot of not doing it in the world. That's what I'm trying to say here. So who am I? Why am I here? Saras gave me a very nice introduction. I have had a lot of experience in a few different markets. I've worked in several countries in the world, a few continents, you might even say. But in the last 6 or 7 years, I've done a lot of work looking at what we need to do about climate change. From the UK Sustainability Board and from the Actuarial Association of Europe, they have their own group who's looking at it. We must have looked at over 1,500 papers. A lot of them said the same things. We also looked at the IPCC, the Intergovernmental Panel on Climate Change, the group of scientists who say things. We looked at their papers, 4,000 pages of dense scientific discussion. It's a lot out there, and there's a lot of good stuff. It's just impossible with a day job to know where to go, to where to start even. So I have these recommendations of papers you should look at to start with. These are the ones that I used on the insurance side. The first one is probably the most insurance orientated, but all of them are good starting places. They don't repeat themselves. They go through the basics and tell you neat things like where to get data. So from thousands of over 1,000 pages to yeah, maybe tens of thousands of pages, yeah, across 1,000 papers, I've boiled it down to, I haven't even counted these, something less than 20. I've also told you on this page what I liked most about each one. So you can dig into the part that I thought was juicy. And if you disagree with me, don't read that one. Maybe you're in a different place. But some of them are really good. It explains things like, yeah, like everything. That's why I'm here. I've spent a lot of time saying, don't read everything that comes out about climate change because a lot of it is repeated. Start with these if you're interested. These are papers, by the way, that you can read in a few days of work, or if you're doing it in the evening because you're interested, a couple weeks of night at home, and you can get through these to at least see what's there. So it's not as bad as it might seem. Right, so let's actually talk about it. I've given a pep talk that we can do it, we can change things. What are some of the elements involved? I've told you about the IPCC. It's a UN agency of scientists. I've told you about the Conference of Parties. There's the International Energy Agency, also has a lot of good analysis. They often have a slant you have to be careful of, but they do have a lot of good data in there. Definitely worth looking. I've talked about the Network of Greening of Financial Systems and so forth. There's also the Joint Research Council, and you can read these without me reading them too. There are a few different types of scenarios that are made, and here are the main groups. These three groups, I think, have the best sets of scenarios that can be readily understood and readily used. Shoot, the PCAF even provides an open source code. I mean, that's something that if you have even a little bit of technical people in your group doing it, you can make some pretty good analysis pretty quickly. On the insurance side, there is an ORSA requirement coming up. This might sound very insurance oriented, and it is. But I think it's a chance for investors. If you are talking to insurance companies, you should know, starting January 1 of 2023, they're required to make statements about climate change. Now, the ORSA is their own risk and solvency assessment. This is a private conversation between a company and their regulator. The regulator is requiring them say something. So a lot of actuaries are panicked because it's a big topic. What is it they're supposed to say? What are they supposed to do? But the requirements are actually, oops, I went backwards, sorry. The requirements are actually quite mild. I think they're more like guidance, maybe even less. So the biggest guidance that they give is use at least 2 climate scenarios. At least one of them should be over 2 degrees centigrade. Well, if you were paying attention to the previous ones, 2 degrees centigrade is probably the lowest scenario we might be having in front of us. There seem to be indicating that this orange and green scenarios would be sufficient to use. But I think if you say business as usual, given what we've actually been doing, a red line that goes up in the air seems like a more probable scenario. The business as usual case may be the best case. The smooth transition and late sudden switching type of scenarios where we actually do something, those might be the test case. Those are the alternative versions. I think that somebody should test big scenarios that go very high, not just over 2 degrees, something like 2.7, or maybe even something in the 5s or 6. There are scenarios for 8.5. Those seem high, but we might be on track for those, considering that that's the temperature we might reach in 2100. So the first thing is be honest about the scenarios. The scenarios will not look like today. The question is not how much of the world will change compared to today. The question is how much of our behavior will change. The ORSA requirements are an opportunity for investors, along with insurers, to start saying what should be looked at. This is not a de facto standard. The regulator has not given any guidance about what to do, not really. And the industry has asked for guidance, and the EIOPA, the regulator, has specifically said no. They want to see what the insurers will come up with. They want to see what people in finance will come up with. That means they don't know yet. That means that this is our opportunity. They even asked, well, how, without guidance, will there be consistency between companies, right? That's when you're doing these types of analyses, consistency is something the regulators look at. But they said, no, that's not important here because ORSA is a private conversation between regulators and the insurance company. So you really can say anything. This is a fishing expedition. Regulators themselves don't know, and they're trying to see what others will come up with. This is the chance to start saying something that's meaningful. A huge opening to set professional standards. Although scared, I think the actual profession is open. Is the investment profession. Are you? All right. So here are my recommendations. In a lot of analysis that we do, we use statistics. I did it earlier when I did my, here's what the emissions were and go forward. We use data from the past to move forward what the future might look like. The past is not an absolute representation of what the future will be. I got it. So you have to make allowances there. Right now, we're in a paradigm change. Statistics is not how to look at climate change. You have to break out of your training and say, let's get some data, let's review the data, let's try to analyze the data. All that effort you did in cleaning data or trying to see that analysis has to be changed. Now, instead of cleaning data, you're going to try to see new scenarios from scientists from a different profession. And rather than trying to ask the question, is this data appropriate? You'll ask, is my understanding of this scenario and how to use it correct? Same amount of work, but it takes a relationship with a sister profession, if indeed we can call scientists sister professions, but they are definitely alongside of us. All right, it should involve all lives. One of the things that will come out of climate change is, for example, is our flood insurance able to be used 15 years from now? In some regions, maybe not. How do we feel about our mortality rates? Well, in currently cold places where people die in the winter, maybe there'll be less mortality because it'll be warmer. But in regions where it's hot already, maybe it'll be higher deaths, partly from people dying of heat stroke or droughts, and partly because there might be, conflicts while people fight over resources. Next is the analysis you do projections over time, or is it shocks to the current portfolio? If you're going to say this is my portfolio today and model how it's going to change going forward while also adding in the climate changes, that's a lot of things to take in at once. So maybe you fix your current portfolio. If this was fixed over time, and then I do the climate shocks, what would the effect over time be? That is a methodology that regulators seem to be open to. All right, and then you change all the statistics. If you're in non-life, you're doing hurricanes, you're doing storms. What's the frequency, the severity? What's the variability of the severity and the frequency? All those kind of statistical analysis you can do. In life and pensions, we have mortality rates. Actually, there will be an effect, but it'll be strange. The mortalities might all of a sudden become more correlated. There might be mass mortality in certain regions. For example, if there's a volcano hit, they've been saying that Seattle, where I used to live, is going to get hit by a 9.8 earthquake any moment now, geologically speaking. 9.8, that's like 1,000 times worse than Kobe. That would certainly correlate a lot of deaths. And then the immigration component is one that's not generally looked at in the actuarial world in insurance. It seems we need to have some sort of overlay on our data to do that. Can't recommend how that goes, but it needs to be considered. That's all insurance stuff. And if I apologize if I've taken too much time, let's get to the asset stuff. Assets. I think that ESG ratings need to be validated. They're used, and there is demand for it. People were happy to take somebody who's doing a rating and start using it. But nobody, to my knowledge, has had a severe go at asking, is that appropriate? I'm also not a fan of exclusion strategies, and I'll go into this in more detail. And we should be suspicious of monetary-based carbon intensity metrics. Let me describe all that. And before I jump into that, what are some of the, I mean, I've read a lot of papers now. What are some missing elements that you could think about? The scientists talk about tipping points, like those 4 tipping points that I mentioned earlier, that ice will melt and release a lot of carbon dioxide. But there are behavioral tipping points. Our behavior could change, and not just on a climate basis. For example, it might become fashionable to have a higher inflation prediction. That's a type of behavioral change which will affect our analysis. Maybe before the inflation increased, we could have asked the question, what kind of event would make me change all my assumptions? And what kind of effect would that have on my analysis? Which assumptions are we using that are sensitive and liable to be changed? We've changed inflation assumptions in the past. Should we be changing discount assumptions? Should we be changing mortality assumptions? All right, that kind of stuff. There is no discussion of treatment of long versus short time frames. And what I mean by that is climate is a long time frame issue. Most of our analysis is, a quarter or two in the future. Even an insurance company only does a horizon analysis over 1 year. Those are short time frames compared to what climate needs. How do you actually marry all that? We're in a market consistent world. We try to take our analysis and try to replicate market values. Even if it's not a marketable instrument, that's our first starting basis. How do we marry that with the real world projections for GDP and that kind of thing that come out of climate scenarios that are in the papers I mentioned? It's not clear how to do that. I give some examples there that may or may not make sense. And then there's the society-company tension, which I've mentioned before. Is the resilience of the company's business model and strategy? This is typical regulatory type of wording. You should determine the resilience of your company's business model and strategy to this climate change. Maybe there's a different question we should ask. What's the effect on society? What are they being left with? Some people in climate talk about stranded assets. We want to have too many fossil fuels. Maybe those won't be tradable in the future. That's a company problem. If we get stuck with an asset that's not producing and we can't sell, that's a company issue. But maybe it was a good thing for society that bad asset for society stopped functioning. A different way to look at it. First thing up, let's look at ESG validations. Out of 23 trillion worth of ESG investments in 2016, this is a little bit of an old statistic, 15 of it was because of negative and exclusionary screening. That means we got out of carbon intensive areas. I think that that's bad for the country, bad for the company, sorry. I think that's bad for the globe. If all insurers and pension funds and asset managers simply avoided carbon intensive industries, what would that be like? We would all sell oil producers. We would all sell coal mines. We would all sell these kinds of carbon intensive assets, but they still exist. Just because we sold them and they're out of our portfolio doesn't mean that they stop functioning. If then the remaining investors who are in those are not interested in ESG principles. We've taken it from us who are interested in it and left it to the wolves, people who aren't interested, those people who have no incentive to change. Although it's a very common strategy, negative and exclusory screening of carbon intensive assets is actually quite bad for the planet. How do we finance renewables or other good things to do? Can we insure a utility price? That's a very topical question. Energy prices are going up today. Would there have been some way that we could have made that an insurance product? Maybe with asset liability management, we could have been invested in producers of utilities, water and gas and electricity or food. Maybe we should be in those things rather than leaving society to be crushed by market changes. Maybe we should try to figure out how on large places we can actually invest for them. Here's an idea. Why don't we finance renewables at a policyholder level? Right now, there are solar panels you can put on your house or geothermal things or heat pumps, these kinds of things. But most people don't do it. Why? Because they're expensive. You might have to put an outlay of 20 or 30 years worth of utility prices all in one go up front. Maybe there's some governmental granting, but it's still a lot of upfront cash. Even if they make money on it, it's more difficult for most people to do it. The financing of it is a roadblock for doing this. Why don't we make a new product in which we finance it? This would remove the financial friction from renewable investments. As long as it has a good investment, if you give them 100% loan to do it, okay, maybe you can fold in any governmental programs as well. You can make a product that from day one is cash flow positive for policyholder. So if you look at their utilities that they're not paying and compare it to whatever it is the mortgage is on this installment, it's less. You could use it as a possible lien on the property. You could even make it a collateralized mortgage. If you did these for a lot of different houses, it would be like having a lot of different mortgages. You can package those up into asset deals and sell them on. There is a precedent for that. The entire mortgage market, at least in America, but in most countries, is based on the fact that insurance companies were willing to take the long exposure to those assets because they had long exposures on their liabilities. Well, if it works for normal property, it could work for any type of property, even ones that produce energy or gas or whatever. And if we're talking about these long dated assets, well, for example, using again the example, sorry about that, using again the example of a solar cell, it's renewable, but it's not permanent. It's long dated, but it's not forever. It doesn't last forever. Maybe it lasts for 20 years. Maybe it lasts for 30 years. Can it last forever? The answer is yes. If you make a maintenance agreement for it, when it breaks down, somebody comes and replaces that part. And then eventually, maybe all the parts were replaced after 30 years. And with a maintenance agreement, a long-dated asset becomes a permanent asset. That's beginning to sound renewable. So renewable isn't just an asset. It's an asset and a service. Why don't we provide that? Or at least give the financing for people who want to be in that business of servicing. How can you encourage insurers to invest long range? Well, maybe we can change the entire insurance market. Now, here is a heretical example. Don't tell my bosses, not yet. A life annuity is a long-dated liability. If instead of a long-term liability, you had a perpetual liability, what would that mean? Actually, a perpetual liability is almost the same value as a priced life liability. Those cash flows at the end, depending on where you are in the person's lifetime, can be very similar, and they can be cheaper. So if you look at the reserve and you don't have a mortality risk, you don't have to have all of that extra reserve for the risk. And if you don't need the capital for the mortality risk, the all-in capital and reserve can be less than it was for the mortality. This could be a new product. It could be a good product. You could, after I die, my perpetual bond is left to one of my children or all my children. That's a good product. Or maybe I could sell my tail when I'm near the end of life, but I need some health care. I could sell it to somebody who wants a good investment. It's a perpetual. Maybe someone who's saving for retirement in their 20s might buy it from me. It would be an asset that I could use to fund long-term care. That would be a cheaper, different market that could replace the life market, at least the annuity market. That's interesting. And it would motivate insurers to think in a perpetual way. While we're doing that, if we're talking about perpetual, we could have fixed perpetuals, but we could also have the actual perpetual linked to different indices like food or electricity or heating. The reason we could do that is because behind it, we have invested in those. When he rises in prices, we feel in the asset side of the company, and we can pass it on, of course, with a little bit of our profit taken out, but we can pass it on to the perpetual holders. That's an idea. Right. Let's get on to two methodologies that I talked a little bit about earlier, but I want to discuss in detail. There are two misleading methodologies. One is this exclusionary or negative screening, and the other one is carbon intensity. So let's dive in. Disinvesting is not a green activity. And I give this particular example that Shell and Eni and Total sold off one of their drilling sites in the Umuchen oil field in Nigeria. I don't know how to pronounce it exactly, to a privately backed somebody. And this particular oil field had a lot of flares that they would need to burn off some of their oil and gas. So that's before the sale. You can see on the left-hand side how many flares there were. And these flares are definitely greenhouse gases, and they made Shell and Eni in Total look bad. So they sold those assets, and they looked more green afterwards because they didn't have those flaring assets on their books. But look at what happened after the sale. The new company didn't care how they looked. They increased their flares by a factor of, I'd calculate it, but I forgot it. It's like a factor of 8 or 10 or something like that. So this action that made Eni and Shell and Total look greener, on total was worse for the globe. They washed their hands of it and looked green, but the world was worse for it. Now, this is a specific example just to identify the problem, but it's an ongoing problem. Disinvestments in the oil and gas industries are increasing, whether you count by number of deals or by value of deals. And the reduced environmental commitments in those deals are getting worse. Now, if you're very interested in the details, again, I have links, but there have been a number of transactions, and by value of deals, the amount of lost environmental protections has increased with these deals. Disinvestment might be something that we accidentally make ourselves look green while the world is getting worse, but there's at least one industry that is doing it proactively to make themselves looking green while the world gets worse. So let's not do it us. And let's call it what it is when we see it. So I would distrust exclusion. And exclusion, by the way, also is underweighting. So it's not just selling off specific assets. If you have a portfolio and you have a certain benchmark that says we should be in this amount of energy, and you underweight energy because energy is generally a carbon intensive industry, that is also a type of exclusion. You're making your portfolio look to have less carbon intensity because you've reduced your exposure to energy, just as an example. But that's not helping the world too much. It doesn't stop those companies from operating. It potentially leaves them to owners who are unconcerned by climate. And more to the point, by being in energy less, you are not investing in alternatives that are less carbon intensive. You're not creating that market to compete with the carbon intensive energy. So I would say, I can't say no exclusions, but you should definitely distrust it and give it a clean look. Is this really helping the world, or is this just making me look green? Or if I'm seeing somebody else, is it making them look green? And then point it out. Carbon intensity. So let's talk about it. I'm going to talk about this fraction here for a little bit. And when we talk about the emissions in carbon intensity, we'd have the amount of emissions divided by some sort of exposure number. And it's usually a monetary exposure. So let's talk about the numerator, the top part first. When we measure carbon emissions, there's generally three different types: scope 1, scope 2, scope 3. Very clever names. And when people explain these to you, it usually looks like this. It's not immediately clear what this all means. Oh, yeah, the scope 1s are here in the middle. There's a scope 2. Oh, there's two different types of scope 3. What is this all doing? So first off, let's talk about how we count emissions. Scope 1s are the direct emissions, things your company did. If you're an asset manager, you may not be burning gas on your premises, or maybe to heat some of your people in the winter, and to keep it warm inside. Maybe you do that by electricity, but if you do any combustion for any reason whatsoever, your company, you're doing it, that's a direct emission that you did. Also, mobile combustions, the second point here. If you have a fleet of cars associated with your company, maybe you just give them to your executives, or maybe you're a logistics company. You have trucks going back and forth. All the combustion that they do, that's part of direct emissions. And the direct emission seems pretty straightforward to understand. They say fugitive emissions, which, again, why such a mysterious name? This is leakage. How much of your greenhouse gas did you not burn, but it still leaked out and got into the air? You have to count that somehow. All right. And the last one is process emissions. If you're not in an investment company, but you're maybe making steel, process of making steel emits greenhouse gases. Those are parts of your processes of making your things. Those are direct emissions. If you're a farmer and you raise cows, they're giving off greenhouse gases, and that has to get included as well. That counts as direct emissions. Sometimes it's not obvious how to measure them, but this is what you should be measuring. Scope 2 is, did you have any providers who, on your behalf, did emissions? So for example, suppose your electricity came from a coal power plant. Well, the coal is one of the dirtiest ones, so their emissions from burning the coal, that would be their scope 1 emissions, but it gets turned into electricity, goes to you, it counts as your scope 2 emissions, right? So because you are contributing to the market of that requires those emissions, or does those emissions. So you get that counted in yours. If you don't burn gas on your own, but maybe you have some sort of circulated water among a bunch of buildings that you share. Somebody else heated it, not your company specifically. Well, then that also counts as an indirect type of emission. So somebody did the emissions to be able to give you this that was necessary to your operations. All right, scope 2, there's a few things more to learn about it, but that's basically all of it. Scope 3 is everything else. Everything in the supply chain before or after you that has some sort of emission associated with it, that's all there. These are the scopes. There's pages and pages, hundreds of pages describing these with examples, but a lot of it can be very easy to manipulate. First off, there can be very inconsistent treatments. Maybe when you do your electricity, you don't care that it came from coal burning. Maybe you just use some number that electricity has countrywide. If you're doing electric vehicles, if you have a personal electrical vehicle that you use and electricity is coming from coal burning, then probably you shouldn't get credit for the electric vehicle. But so there can be inconsistent treatment. Some of these are hard to measure directly, and so any kind of rule of thumb you use can make them inconsistent and maybe even difficult to justify. There are offsets. We talk about carbon offsets. Where they fit into this picture is not defined in the literature that I found. Some people use it, some people don't. Carbon offsets is an entire another conversation about how they may not be doing what they need to be doing. But most importantly, in this scope 1, scope 2, scope 3 business, there is double counting. All right, I mentioned that when they made the electricity for me, their scope 1 emissions are my scope 2. Part of this scoping is to try to put in a shop window the double counting. They have it as scope 1 and we have a scope 2. Somehow we've double counted, but we see it. Sometimes there's zero counting. The example I want to run by you is just consider an oil company. They produce natural gas or oil. They mine it or whatever. And where is that in all this? They're not burning it. It's not in their direct emissions. Okay, maybe there's some energy they use in the oil well rig, or maybe there's some transportation costs, but they're not burning the oil in the car. It's not their scope 1 emissions, not their scope 2 emissions. It's your scope 3 emissions. Oil companies, their entire contribution to the availability of fossil fuels is a scope 3 type of emission. And not all areas in the world require disclosure of scope 3 emissions. So one of the biggest examples of fossil fuels emissions may be not counted. Well, that's something to be skeptical about. So when we're looking at the emissions, direct emissions sound good, but if we don't hook up the people who are making the profit from the people who are eventually using it, I'm in the car, I don't make profit from mining oil. Somebody else makes the profit, but I am using it. Yes, I'm directly emitting it. That's true. But somehow it's not going back to the original source that made it so convenient. So be skeptical about the actual emissions calculation. Now let's talk about the exposure. Generally, after calculating the emissions, we make an intensity by doing some sort of divisor or something in the bottom. When we divide by something, and we usually make it a money exposure, like the revenue of the company or the income of the company or the profit of the company, maybe the market share. This actually makes sense on a basic level because if you're doing analysis of a different portfolio, you have these statistics handy. And if you have a big company, yes, it's going to put out more emissions. You want to account for that, so you divide by something else that's big of its income or its revenue, or if it's a country, its GDP. On some basic level, that makes sense. But this is actually quite misleading. Consider, for example, If your company has a higher revenue or a higher market share or higher GDP, your denominator is big. It's bigger. You will look like you have a lower intensity just because you have better profits. Right now, oil has come down a little bit, but oil prices went up. If you're counting profits, the oil companies look greener than they did before the Ukraine war. That's just a wrong answer. And it's because we're dividing by a monetary exposure, profit in that case. That's a bad result. As long as the economic growth, that denominator, whatever it is high enough or growing faster enough than our carbon emissions, then it looks like our intensity is improving. But this is a basic statistic. If it gives the wrong direction, let alone the wrong size of what we're looking for, it's just wrong. It's just not something we should be using. What should we be using? How do we fix it? Use a non-market exposure. Instead of doing monetary exposures like income or revenue or profit, say what it is you're making. Did we make kilowatt hours? Or is it logistics that we're doing tons of stuff being shipped so many kilometers? Would there be kilometer tons of things being shipped around? Or for commuting people, is it kilometer people that we're moving around? If it's heating, we should be BTUs or joules. Replace all the monetary exposure with what was actually made. In software, it could be people hours of engagement. That could be a business software, or it could be educational or games. You know, how many hours are people using it? I can count the productivity from what my kids are doing downstairs in their room right now. And if we have products, say how much of that product you made. Cement, tons of cement, liters of gas, barrels of oil. Say what it is you're contributing to the economy, and then change your analysis like this. Here's the new analysis. So previously we just did that emissions divided by monetary exposure, but now we're going to have different sectors of our portfolio. This is what we've produced, right? And this is how much total kilowatt hours we've made. This is how many tons of kilometers of things we've moved around. This is how many people we've commuted for how many distance. This is how many tons of cement we've made, and so forth. Then on a per ton basis or per kilowatt hours, what was the emissions of that? So we can figure this out. This shouldn't be too much more data than we already have. We should have this kind of information with a little bit more digging into our companies. Now this would be the analysis we do for a benchmark. I've used B's for benchmark. And C's for the carbon effect. But then we repeat the analysis with our portfolio. We might have less in energy or more in energy, but whatever amount of the kilowatts that we make, we use our amount. And then how much of our amount that we're making contributes on a per kilowatt hour or per kilometer ton basis, how much does it contribute to emissions? And then we can compare the benchmark to the portfolio. And this should be easy peasy for people who work in investments and actuarial work. If you want to say how much your portfolio improves over the benchmark, you just do a weighted average. And in the denominator, you use your exposures, not the benchmark's exposures. So that means it's on a like-for-like basis. Given your exposures to different industries, compare the weighted average of your carbon emissions versus the benchmarks. So in other words, don't use the benchmark in the denominator. You should take account of which industries you are in. And this simple change removes all those problems I was just discussing. Slightly more work, but it allows you to look at the detail and on a like-for-like basis say, are we doing good for the environment? This removes the distortions like I just mentioned. It requires additional analysis, but it's not that bad to get. It also says, where do we cut back and when do we use cleaner products? If you dive into it, you can say, okay, my portfolio might be emitting too much, but that's because the amount of emissions per kilowatt or whatever is too high in this area. maybe I can change what I'm doing there, or I can do less of it. This could also be used on a societal basis to say, where do we need innovation and where do we need to tell people to stop consuming? And most importantly, this encourages investment in green and sustainable investments. If you have an idea for renewable energy that puts out, for example, no carbon, then you get a lot of zeros credit for that. You could do more energy there and have a proportionally greener looking portfolio and a truly greener one that is serving society. So I've discussed quite a few ideas in broad brush. I've discussed the emissions and the exposures and the exclusionary negativity and some other general issues. But can we save the world with this? How does it work? Well, the UN has a lot of goals for saving the world. They range over all sorts of things. And why is it tough to get things going? Like my animation isn't going. Why is it tough to get my animation working? Oh, here we go. So yeah, so here might be one thing that we say, well, here's the world is turning. I want to have some climate action. That's good. But any action we put in the climate, it's going to take some sort of resources from the world. Okay, that's great. Oh, well, maybe we should also have sustainable cities and communities. So, sounds great. These are hitting all the UN goals. It's obviously what we should be looking at. Other people might say, well, wait a minute, I need to feed my kids and I don't really have access to clean and sanitary water. I would like to do that. And they have a point. I mean, climate is a 50, 80 year problem, 30, 50, 80 year problem. If people are having trouble with water and food today, I can't blame them for like standing up and wanting to do that. We should sometimes help them too. We should get that into the mix. Maybe we need to give them decent work and economic growth and some sort of industrial infrastructure. Okay, sounds very general. How does it actually fit in? It's a good question. Well, maybe quality education will start helping with the feeding, and it can also do climate stuff in around ways. But yeah, let's get affordable and clean energy into the mix. That's going to do it. Well, while we're at it, if we're doing things, we do want gender equality. That's one of the things that we talk about. Okay, I'm up for that. And while we're doing equality, there's a lot of inequalities in the world. We can start working on those. And the whole point is that these are all laudable plans. I cannot fault anybody from wanting to do any of them, but it starts pulling the world in a lot of different directions and nothing gets done. And there's other interests in the world. Okay, I've used only dollars. I could have used pounds and euros, whatever, but they pull the world in their own way. And this is the model of the world why, yeah, there's no net momentum in any particular direction. How do we solve that? Here's a general idea. You might recall how to do linear programming problems from school, but there's other non-linear programming problems. But here's an idea. A company makes some products, P1 and P2 up to PN. It has a bunch of different products, and its profit is some combination, some linear combination of how much they sell of each of those. Great. And then how much resource do they use of all these? I have some numbers in from resources. We've had training. I hope the use of letters doesn't throw you off. I don't think it should. But they have all these restrictions. We only have this much of resource one, this much of resource two, and so forth. But then the quant people come in and say, okay, that's the target. We're trying to maximize that. Here are the constraints. How do we go about doing it? And they come up with a solution. Great. That solution is the max one. Meanwhile, there's another company over here, and it's doing the same thing, but slightly different. Instead of P's, I'm using Q's, but they have their own products that they sell. And they have resources as well. I'm listing theirs by S rather than R, but it's all resources as well. Here's the thing. They can calculate their own maximal optimum with what they have. But here's the thing I wanted to say, that they might use some of the same resources. I've represented that by being on the same line. So for example, company 2 uses resource 1 just like company 1. They have a different amount of it. They have S1 rather than R1, but they use the same resource to some extent. Okay, company 2 doesn't use any of the second resource, but they both use 3 and 4. And resource 5 isn't used by company 2, but 7 and 8 are not used by company 1. But there is an overlap. These resources don't have to be like oil or gas or sand. They could also be educated people. These could be different software. These could be anything general that helps you to get your business done, a resource. Well, here's the interesting thing. They can start working together. We said that they have some resources that are in common. If they combine their forces, we get a larger problem combining it together. Now we have the sum of the R1s, we have the sum of the resources, they're using them together, and maybe they will come up with a different answer. Since they're having some overlapping resources, maybe working together, they'll have a different solution. Here's the wonderful part. If you look at what the max of them working together, this max 1 and 2 together, it'll never be worse than them working individually. Working together always leads to the potential for profit, and it's never worse. That's interesting. That's actually amazing. I think that should be how we see how to relate things together. Just see what is it that they're working with. And as long as they have some common resources, we should be able to make some sort of deal. Okay, so we have to have some common resources. The joint solution is never worse. By the way, if you're kind of a mathematical thing, there's an easy proof for that. The two individual feasible solutions that they had for problem 1 and problem 2 could be something that they do together. And so they could recreate what they did individually. So that's one potential solution. Anything would have to be better than that. It's an easy solution. It's an easy proof. That doesn't matter. The partners could have completely different goals. Their goals may not be profit. They might be number of educated kids. They might be access to new water. It could be different goals. And as a matter of fact, the more different their goals are, the easier it is to make a deal, usually. And partners don't need to be companies. They could be any group. They could be nonprofits. They could be countries. There is a negotiation path. If you do the combined theory and then you say, oh, there's a better solution, who gets the extra profit? How do they split that up between the players? Well, that's an interesting question. I don't have a solution to that, but there must be something that's better for everybody. Just how does the bigger player get more of it? Interesting question. That's a game theoretic question, which always has a solution. Like I said, it's easy to find a quick search for partners who are using similar resources and get them together. And now here's the thing. I clicked on accident again. Sorry about that. Go back. Any number of partners can come together. The reason I think that this view, this conceptual view, could change the planet is because 2 partners could come together, and then they find another group of 2 partners, and now 4 people are together. And then it could easily go to 8 and 16 and come together. Step by step, you only need to see who your next partner is, and then go forward. And how you actually come together doesn't always have to be a merger. It's a very finance kind of way. Oh, we're going to buy you and we're going to combine it all together. Oh, and we're going to fire half of everybody at the same time. Not quite the only way to do business. But working together can just be working together without an ownership change. A very good example that I've put a link in here is cement and steel. It turns out that the clinker that you put in to make cement, to make concrete from cement, is very similar chemically, almost immediately the same as what they use in making steel to take out the impurities. So at the end of the steel making process, there's normally a bunch of emissions. But by using previously ground up concrete as that substance that takes off the slag, you can prevent new emissions. And so by combining together cement and steel works together, you can completely remove the waste that comes from throwing out the cement and the emissions from making new steel. And it's a little bit cheaper, if I understand well. that's a great example of a multi-solution, but it takes a chemist to say, oh, they're both using the same chemical. So sometimes it's not obvious what the resource is, but it's a very good example of how this works. It's a good article to read. So now what does the picture look like? If we're actually able to start saying, how do we get the world working together on different projects with different goals, as long as they're using the same resources, well, then they'll all eventually be moving in the same direction. Not immediately, but it will have exponential growth to be able to get there. And the trick is, who's using the same types of resources, the same types of inputs, get them talking. And then that'll have the 17th, the last of the UN goals, also be successfully implemented, that we will have partners working together. So in this kind of model, I think even the money people will sort of see the direction of things and maybe not work exactly in the same direction, but they'll be pulling in a non-conflicting way. My final, sorry about that. I don't know why this is doing this to me. Sorry for the technical trouble here. Seeing the repeat makes it not as dramatic. So finally the world, there we go. So finally the world can start moving in one direction. That's the final thing we wanted to show. I hope this has been motivational. I hope it's given you some ideas to how to look at client science. And I've decided to put what we covered at the end, so as it might prompt some questions rather than having put it at the beginning. So I'll leave it over to you, Servas. What are the questions?
Thanks a lot for your very interesting and also quite passionate presentation on climate risk, and also how the investment industry can really make a positive impact on the world. Are there any questions from the audience?
I guess everything was really clear. I personally thought it was quite interesting that you can create sort of perpetual assets from green investments, if you want. And then the part of the benchmark construction, or comparing yourself to the benchmark and measuring your carbon footprint of your portfolio, you were almost touching on something like GIPS, like Global Investment Performance Standards, which is also a standard developed by CFA Institute. So that was all interesting. One thought from my side is like in the investment world itself, I think the actual impact it in itself can have is actually quite limited, in the way that you're just channeling money through companies, usually even on the secondary markets. I do take your point of like, that it's not a good idea to sort of decide not to invest, especially in oil and gas, because we still need it anyway. And as long as there's demand, it will be made. And the examples are quite clear. But all in all, I still think you need more regulation than actually ESG investments to really make a change. What's your take on that?
I see your point, and I think more regulation would work, but I'm a skeptic about it, because they've had a chance, and it's tough to get regulation to go and to get agreed to. So maybe I should make clearer my thinking, that I think there's an opportunity here, that if you can modify how you decide green, how you measure emissions in your portfolio, and if it makes more sense, I think that's an opportunity for sales. So if you can make it clear why your rating is better than the competition, then you will have an opportunity to gather more clients. That was the point I was trying to make. So the demand from a lot of companies and a lot of single individuals who are giving you money, they want to know that their money is doing something correct. And it's a double-barreled shotgun. If you can say ours is the correct measure, and by the way, your competition with your money is the wrong one, I think that that's stronger than regulations. I
Yeah,
think that's the opportunity.
yeah, because then indeed you also trigger the competition to actually do the same thing, basically.
That's right.
Yeah.
That's right. Your so in one sense, you might say that your opportunity for profit is short-lived because the other people would change. But we've seen that people are slow. So the first movers will have more time if they develop it, because the next competition we've seen are actually slow. It will eventually catch up and save the world, but you have a good window of profit to do it right.
No, that's true. And like also for maybe another aspect, maybe it hasn't been touched really in the presentation, but as an asset owner, because like as a big asset manager, you usually have quite a bit of percentage of voting rights. You
Correct.
can actually pressure the invested companies to actually make a transition and to behave. Um, if I compare it also with the bank I'm working for, which is present in Belgium, but also in Eastern Europe, they actually, with loans, they are trying to encourage energy producers to be less CO2 emitting. And they've got even like a once fit sort of solution for all. So basically in Belgium, they're way more severe, so nothing is tolerated anymore. While in Eastern Europe, certain countries still are heavily dependent on coal for generation of electricity. So there, it's more like a talk with clients to create a transition path. And then you do have an actual impact on what's happening on the ground.
Agreed. Yeah, that's maybe the next time I do this, I should mention voting rights. It's yeah, investor action. It's a very good point that I unfortunately left out. Yeah.
I see here one more question. Is there a need to change the law so that companies' main goal is not to just profit seek? Or, um,
So is there?
is there a need to change the law so companies' main goal is not just profit seeking?
Change the law, or what was it we're
The
changing?
law, yeah, yeah. So I'm just wondering myself how,
I don't
like,
think there's a law. I don't think there's a current law that they need to seek profit. They just do it, right?
mhm.
And yeah, it's an interesting one because there is talk about a great reset. It's compared to the idea of a great collapse, depending on who you read, right? But I think that there are functioning markets that you can't just change, but you can use them as they are. For example, there was I was in discussion with EIOPA, with the European Insurance Regulator, and said, well, why don't you put capital requirements for being green? And they basically said, no, we can't do that because that'll just muck up the capital requirements. So if you start putting two goals on, you end up just weakening both. Huh? And I was disappointed when I first heard that answer, but then I decided that it was right, that we have a functioning reserving and capital regime. If we destroy that, then we won't be having access to the assets to be able to make actual change. We have to be a little bit smarter than that, than just say, oh, have a different goal. We have to find the current goals and how they can be used to do the right things for society. The example given is if you can show a greener green in our rating methodology, then you'll get more clients. That's not destroying the profit goal, that's using it. I think in my multi-solving example, I was trying to say, don't go in and tell company two they need a different optimization that they want. Use it as it is, and then make it better all around. That's the goal. I think there's a lot of friction that occurs from trying to set rules like people don't go after profit. Yes, there are some restrictions that need to get into place, but but too much of that just means that we're pulling all in different directions in the world and not going anywhere.
No, I agree. It's probably best to sort of respect how the market works, and in trying to implement changes and creating a change of culture, if you want. I am looking here. There's like a couple more questions in the chat. I'm looking at investments and returns. What is the difference between the clean tech bubble from 1990 to 2008 from now? I don't really.
It's a general question. I
Yeah.
haven't got data. I can't look up on my table
Yeah.
here to see anything between the numbers.
And then, like maybe because that's question one of the same question. Second is the majority of clean tech investments are in hardware, hence require high capex and longer time to reach profits. What could investors do? And then third, where and which are the low-hanging fruits and investments in reducing climate change? Thank you for the presentation and sharing your time with us.
My pleasure. I am a big supporter of getting individual people to get their own renewable stuff. I think that putting geothermal in housing or small apartment complexes to have an independent one, I think is philosophically sound, but I think it's the place with low hanging fruit. It is slightly expensive and needs a longer time frame for investment return, but that is exactly where the investors can come in, especially if they're talking to insurers that have long dated things. I think that is actually where the low lying fruit is. What was the second and first question? Sorry, I should have nodded them.
So
the tech where we are.
Mhm.
It's a good question. There are some developments. There is a view that we'll just use technology to get out of all this. Maybe it's true. The carbon storage and capture and storage is not readily feasible, but maybe it will be feasible one day, but it's not. So we have to push on other things. I think in the time period that the question asked was somewhere in there is when the EU started doing their restrictions on carbon emissions, huh? And their emissions on the European wide have actually gone down. So there is evidence that that works. In other places like America that did not implement that, didn't have it work. So does that count as a technology? I'll say yes, because I can give an answer. But
Yeah.
a more general one on the capture, it's not there yet. There is also technology or processes by carbon offsets, saving trees and stuff, but it's a completely different conversation. It's a longer conversation, but I believe most of those markets don't work at all. Those are clear indications of greenwashing, even if you follow the rules. Some trees are not in risk of being cut down, and even if you believe they were in risk of being cut down, you take all of the life emissions of the trees and say and you attribute that to one person for a pound. But there's no process that allows those trees to be shepherded in the future. It's just this one time we've saved them, rather than making sure that they'll always be there. And any kind of carbon emissions or carbon offsets are very difficult. Elon Musk made billions by selling carbon offsets, which is interesting because that would make him one of the greatest polluters now, right? If he's taking on the carbon emissions from, he is to an emitter, then he has enabled them to do more emissions. So we should label him as a polluter. That's not the way the carbon offsets work. It just disappears. Everybody's green, which is obviously the wrong answer.
Yeah, that's an interesting thought. By transferring these emission rights from polluters to like Tesla becomes actually a dirty company. No, like, and then maybe a final question on credit rating agencies, and I guess also like sort of probably that's not in the question, but like the data providers like Sustainalytics, can they play a role, or what role do you see them play to support sustainable investments and help the financial industry?
I definitely think that they can play a role. Most rating agencies already do some sort of ESG rating. I think that they see the demand for it and they're able to put something in place. And I think that that will play a strong role. You don't need to change the credit rating, but it's another rating that goes next to it, huh? But it has to have more dimensions, like I was describing, not just a rating 1 through 5, but actually a description of what it's producing and on a per basis, like that chart I gave of what our emissions are. You need to have that more detail. They need to stop doing easy ratings and need to doing meaningful ratings. And then that is one of the market forces that could actually change the world climate-wise. So that's an existing market. If you just made the statistics meaningful, then actually the investors could save the world.
I think that's a nice one to conclude the evening on. I don't know if you still have something to add, Servaas. Otherwise, like I would like to thank you for a very inspiring talk you gave, Matt, and thank you all for joining us, and see you on a next occasion.
Thank you for inviting me, and thank you for your attention. Have a good night.
Okay, bye-bye.
Thanks, everyone. Bye-bye.
Bye bye.